Dividend investing is a fantastic way to earn some extra income or generate wealth for the long term. There's nothing quite like receiving regular dividend payments for doing absolutely nothing other than owning a portion of the company. While it might start off slow, over time, diligent investors are able to earn a full-time income from the dividend payments alone. Imagine earning $100,000 or more per year from dividend payments, while the principal of your investments continues to climb and your dividend payments tend to increase proportionately. For most of us, it takes quite some time to get to that point, but even an extra few $100s per month is great. That money could be put towards a new car, family vacations, adding to your entertainment budget, or simply reinvested. Here's what's desirable about dividend investing and how you can benefit. If you enjoy videos about money, personal finance, and topics that will help you improve your financial situation, subscribe to the channel and hit the notification icon to be notified of new videos. Also, make sure to hit the like button if this video is helpful. Dividends are payments dispersed to shareholders, usually quarterly, for simply owning the stock. Why do businesses pay income out to shareholders instead of reinvesting and growing the company? Management has decided that a percentage of their net income, or income after expenses, is better spent when paid out to shareholders rather than reinvested in the company. This is typical of larger established businesses who have little room to grow in comparison to small growth stocks. In other words, when there's a Home Depot in every town and future growth is somewhat limited, it might be a better use of capital to raise their dividend payments. Dividend-paying companies tend to perform well during times of uncertainty. Investors tend to shy away from growth stocks that don't pay a dividend during times of looming or recession, because even if the share price of their stock plummets, their dividends are likely going to continue being paid, unless of course the company runs into greater trouble and needs to decrease the payments, or worse, the payments are ended altogether. This is very unlikely when purchasing stocks with solid fundamentals, and even more unlikely when purchasing index funds or ETFs. The chances of a basket of stocks failing to make their dividend payments is very low. Investors who are willing to take on a little more risk could buy individual stocks that pay dividends. Some common names would include Clorox, Chevron, Realty Income, 3M, and Johnson & Johnson. These 5 companies pay 2 to 4% of their share price annually to shareholders in the form of dividends. So if you invested $10,000 in these stocks, you could expect to receive anywhere from $17 to $33 per month on an annualized basis. This isn't a lot, but keep in mind that the value of the shares is likely going to rise as well. When buying individual stocks, consider the payout ratio or the percentage of net income that's paid out to shareholders, which will give you a peek into the health of the company. Healthy payout ratio should be less than 55%. Many new investors make a mistake of buying a stock simply for the high yield. There are many factors into determining whether or not a stock is a good investment, but payout ratios are most commonly used to gauge the health of dividend stocks in addition to other metrics. Keep in mind that if the stock has an unusually high dividend, it might be because the stock price has dropped, and the dividend payment amount could be reduced if there were an issue with the company. Some companies may choose to take on debt just to fund their dividend payments, which is obviously a sign to stay away. The best way for most investors to take advantage of dividend payments is to purchase an index fund or ETF. There are many different options available, including funds holding international stocks, only dividend aristocrats, real estate investment trusts, or funds that primarily own high dividend stocks that are held within the S&P 500. By purchasing a fund such as these, risk is spread across many different companies and possibly sectors. This way there is no need to rely entirely on the health of one single company. The chances of the dividend being eliminated are funds such as these is extremely low. Alternatively, the share prices of most of these funds tend to rise over time, so you're also enjoying the benefit of capital appreciation. When you purchase an individual stock, anything could happen that can reduce the share price, including lower than expected earnings, other bad news, or downgrades from stock analysts. Dividend investing is a great way to earn retirement income for those who have a large enough portfolio to do so. For example, a retiree could buy a dividend index fund or a TF yielding 4% and live on the dividend payments alone. If they had $1 million invested in this dividend fund, they could receive $40,000 per year in dividend income. In addition to the capital appreciation they're likely to receive, people with a larger sum could even live on a lower dividend yield, like a fund of the S&P 500. An S&P 500 fund yields less than 2%, but that might be enough for some people who live off, especially if they have a good chunk of money in their retirement account. Dividend-paying investments are good for more than just an income they provide. They tend to be more stable through various economic cycles, which might deem it reasonable for an older investor to keep more money in these assets instead of keeping an overwhelming percentage of their portfolio in bonds. However, in a performance comparison of the S&P 500 and a high-dividend S&P 500 fund, a high-dividend fund failed to beat or even match the returns of the S&P 500, even with dividends reinvested. This is typical behavior of older income-producing stocks. Even though volatility is lower, the opposite is true of a growth stock fund. The growth stocks outperform the S&P 500 over the long term while providing very low dividend income and higher risk. What's most desirable about dividend investing is that the income is more stable during rocky market cycles. The chances of a company continuing to make reliable dividend payments is much higher than a growth stock continuing to appreciate when the market isn't performing well. The dividend-paying companies are much more stable than their smaller growth alternatives due to their age, the fact that their systems are in place, and that they've probably endured bad economic times in the past. Also, the fact that investors gravitate towards these investments when times could be better helps support the share price and keep it more stable. Compare this to growth stocks that investors tend to dump when the economy slows. The biggest downside to dividend investing is that growth tends to be in the lower end. These dividend companies are already large, and instead of spending the entirety of their income on investments within the company, a portion of their income is distributed to shareholders. Small growth companies tend to spend more money on research and development, capital expansion, acquisitions, and acquiring new talent, which will help them grow at a more rapid pace. However, there is something to be said for taking a small hit and potential capital appreciation in exchange for reliable dividend payments as the market fluctuates. Dividend investors will tell you that those steady payments help them sleep better at night, and they're happier holding stocks over the long term when they're receiving regular payments. The best of dividend investing usually means buying a company whose share price likely to rise combined with a reasonable dividend yield, say 2 to 3%. This way, you're enjoying the stability of a dividend stock and the incumbent provides, along with capital appreciation. The last thing you want is a stock that's price declines because it can't afford its dividend. Will you receive the growth of large names like Google, Amazon, and Facebook? It's unlikely, but the reinvested dividends will provide you with a comparable or turnover time. To stay in the middle of the road, you could purchase individual dividend stocks with high growth, or simply purchase an index fund or ETF geared to achieve this goal. If a higher yield is more desirable or necessary, real estate investment trusts or REITs might be a good choice. REITs are required to distribute most of their net income in the form of dividends to shareholders due to their business and tax structure, so instead of the stock paying out 40 or 50% of their net income, REITs will be paying out 90% or more. Consequently, growth tends to be lower than the overall market with the S&P 500, REITs, or individual stocks. So it's necessary to perform proper due diligence and risk assessment before purchasing individual companies. Alternatively, REITs funds are offered by companies like Vanguard, where you can purchase a selection of real estate investment trusts. This is also a fantastic way to gain more exposure to the real estate market, which has historically performed very well with a reasonably low volatility. Although most companies pay their dividends in quarterly increments, there are some stocks that pay every single month, such as Realty Income, Shaw Communications, and Gladstone Investments, as well as a selection of ETFs. If you're only receiving dividends from companies that pay quarterly, you might find it difficult to budget the income, especially if those dividend payments are your main source of funds during retirement. You could buy various companies that pay their dividends during different months, though the payments are more continuous, or you could invest in a monthly paying ETF, such as the Invesco S&P 500 High Dividend Low Volatility. That way you have the advantage of owning an entire selection of stocks across various sectors that will distribute the dividends on a monthly basis for a reasonably low cost. There are also higher-paying funds that own specific sectors, such as financial services, healthcare, and telecommunications, all of which are known for paying higher dividends. With these funds comes higher sector concentration, so make sure you're properly diversified. You don't want to be stuck without an income if one sector runs into trouble. It's important to remember the dividends, while stable, are never guaranteed. During the Great Recession, when the banking sector was in trouble, many of them, such as Wells Fargo and J.P. Morgan, slashed our dividend. Bank of America, for example, at a dividend yield of over 7% in 2008, right before the Great Recession, even as the share price was hovering around all-time highs. About 1 year later, they'd cut their dividend to less than 0.5%, leaving investors who are relying on the income bind. Occasionally, when companies are underperforming and their numbers are subpar, they're forced to reduce their dividend payments, which consequently affects their share price too. If a company reduces their payments, investors lose out on the income, and many of them choose to move their money to something else. A slashed dividend could also be a sign of lurking bad times. Mitigate this risk. Spread your portfolio across different holdings and sectors, including industrials, consumer staples, consumer discretionary, and so on. A high-dividend S&P 500 fund is a great way to diversify because it holds a variety of different sectors. Lastly, dividends are often taxed differently than traditional stock investments, depending on the accounts you use to purchase investments. Whether or not the dividends are qualified and what income tax bracket you're in will all have an impact on your tax bill. You may find the dividend investing is preferential when considering your tax situation, but it may also be true that your taxes will be higher when utilizing a dividend investment strategy. It's worth speaking with the CPA about your situation to avoid paying more tax unnecessary. Most people who hire a certified public accountant will tell you that they were able to save them much more money than they charge for their service. If you're looking to increase your monthly cash flow so you have some more room in your budget, investing for dividends can be a great way to do that. However, dividends are most beneficial when they're reinvested so you can earn compounded interest. Remember to purchase investments that will also increase in value, because the dropping stock price will still lose you money, even if you are receiving dividend payments. A retirement plan consisting of income derived solely from dividend payments is very desirable, allowing the principal of your investments to increase, and ultimately the amount of your dividend payments. Utilizing this method will leave you with reassurance that your retirement income will last as long as needed. This eliminates the question of whether or not retirees will outlive their investments and prevent them from having to worry about paying bills during their final year.